Hello, and welcome to another chapter in Accounting 2302 with your host, Professor Naragon. Today we're going to go over cost behavior and cost volume profit analysis, so the CVP, and we're going to change things that we've kind of already looked at through 14 and 17. Since these deal with other cost methods, now we're going to get into basically how much should we sell to make break even? How can we target our sales price? So you're going to see a lot of new terms coming to you, plus some things we already know. We're going to go more into depth of different costs and whatnot. So starting off, what is CVP, the cost volume profit analysis? Its job really is to predict how changes in cost and sales impact the company's profit. And they're going to answer some basic questions. They're going to basically answer how many units we must sell to break even, the change in income if selling prices decline and sales volume increases, and sales volume to reach a certain target income. It is overall all an estimate in the end, but it really does help to know if I target this amount, these many units or this many sales, will it work? And then we can also use this analysis to look at how much of an income increase if we decide to reduce a machine, introduce a new machine, or really a sales mix. If we sell multiple products, can the income change because of that? So most of this chapter, we're going to do it one product until we hit that sales mix. But you get to see how this process goes. This is a long chapter. A lot of stuff's going to happen. So we're going to try and get through it as best as possible. Alright. The most basic form of CVP analysis is the break-even analysis in itself, which definition-wise is again the amount of sales needed in units or dollars to not make any money. Zero. Just to make zero. Just so that we have covered costs and that's it. Now, this isn't the great thing, but it's always good to know this just in case, you are having a bad month or something like that. You at least know this is at minimum how much I should actually sell. However, since we do use this for break even, it actually is best and most effective when it's a relative range of operations. This essentially means that the normal range of operations for a business, either extremely high or low levels of production, are not usually considered in this range. Because there are various costs that can be actually more accurate in conditions and environment within the business to make that significant change. So this uses a lot of variables. But we're going to try and keep it very simple for this one. Again, if you take cost accounting, you're probably going to see this a lot more in depth. Here, we'll try and get you the basics. So this is the basics of the CVP. Alright? So, for us, there are a few assumptions that CVP has to be more accurate. The first assumption is costs can be classified as either variable or fixed. We're not doing too much of a mix, but there can be. Costs are linear with the relevant range. It means they don't fluctuate a lot. All units produced and are sold. Inventory levels do not change. So we're not dealing with FIFO, LIFO, weighted average, all those fun little inventory levels. They basically this one just says, if it all sells, it all sells. Yay. And when we get into the sales mix is constant. It's going to follow a ratio. So we're going to go with that. Okay. Types of costs under CVP analysis again brings out the fixed cost. And in previous chapters we brought up fixed costs, and basically it's known not to change as total production. The strange thing with this is that when we actually spread it across units and actually look per unit, the fixed cost will change. In fact, it will most likely decrease as more units are produced. If you pause a little bit and actually check at the example, it actually shows this going on. Because fixed cost is absolute. The rent of a building is going to be the rent of the building no matter how many units are produced. Well, if we just look at units, of course, the more units you produce, the less fixed cost needs to be put in. Now, variable cost is coming back too. And variable cost does change when we look at the total production of a business. As the volume changes, variable cost will change. But when we look at the per unit view, it doesn't change. We know exactly how much direct materials, how much labor, how much overhead is probably going to be involved with each of our units. So at a per unit state, variable cost does the flip. It is constant. Nothing changes. Okay? So that's actually pretty interesting that when we look at the overall picture, fixed cost is in its definition, does not change. Variable cost does change. But when you look at the per unit value, they flip. Pretty cool. Okay? So the notes actually give you two graphs to actually show you this. One is the actual reflection of what really happens. Fixed cost in the overall picture is constant. Variable cost is going up. And this will make total cost also going up. Just basically almost like a parallel line to variable cost. And this really brings total cost does equal fixed cost plus variable cost. Okay? So if you ever had a question of what total cost is, that's really what it is when we get into it. But, and again, if you check out the notes, you can actually see the little definitions that are going on. But the main focus is what is total cost. Now, when you look at the per unit base, notice this. Variable cost has now gone constant. But as we produce more units, fixed cost actually starts to go down. It comes in this like half parabola. Okay? As you notice also, total cost is going to mimic fixed cost now. Now, of course, total cost cannot go past variable cost, but fixed cost could. And we could eventually produce enough products where we actually have a negative version of fixed cost associated. Down to almost zero, I should say. Negative when it comes to variable cost. But it really is kind of interesting how it goes. Now, we're not going to get into too much of those kind of items. We also gotta watch out a little bit. Mixed cost in themselves. These are both known as fixed and variable. So example really is sales, our sales staff. We may actually give them two options. One could be a monthly salary, which is fixed every month they get it. Then we could have a variable cost component of commissions, where they sell so many products, they get so much money. That's the definition of a variable cost. We don't have control of that, they do, kind of thing. Same thing with another example with the factory itself. Utilities. There's going to always be a base charge for a utility, no matter how much you use. That's known as a fixed. The variable could be the actual charges you do. So, you can vary on the wattage throughout the month. We already know this with our personal electricity bill. It's usually not the same, but it does have certain fixed costs to it. Now, this one is another little thing that they threw in. That's a good analysis that just shows how fixed cost and variable cost kind of work too. When we look at stepwise, it's going to literally look like a step on the graph. And this is mostly because it works more with fixed costs that we actually have to increase on. Here, we're taking the example of managers. Managers with salary. Well, if production goes up, we are going to need to hire more managers. And as soon as we hire a bunch more managers, our fixed costs would actually go up. And stay, again, fixed for a while until we got to hire new ones. That's going to be mostly a little bit of this. Again, this graph is trying to show break-even analysis again, but that's why it's got that relevant range. We're not going to focus on the stepwise graph. In fact, most of the graphs we're not going to mess with. Okay. Curvilinear cost. Now, as you can see, this is more of a wave that goes on. Now, these costs are, as volume increase, they don't really deal with a constant rate. This is usually our kind of mixed costs getting hit, and it really is a little bit different. As this one takes on total direct labor costs. At low level production, employees are not effectively due to have enough help, too much work, so forth and so on. But as production levels increase, things start to even out, we start getting more help, everything's adding up, workers are able to find more work to be productive. But as more employees are added because we think it's going to help, they can also increase more inefficiency, and it's really a complicated mess here. So we're not going to go too much into the curvilinear. It's just good to know what it is. Okay. So how can we identify the measure cost behaviors? These are the things that we're going to actually look into as we go into the more methods. Okay. Identifying cost as either fixed or variable. That's going to be our step one. And we're going to really look at if it changes or not changes. That's typically we're going to look at when the production changes the overall picture. So again, if it changes, it's variable. If it doesn't change, it's fixed. Alright, step two, we're going to develop a cost equation. And these three methods used to develop a cost equation, there's really three. We're going to focus on one in this video. If you would like me to go through the other two, you can put a comment down below, and we'll actually go, and I can post up a video later going over the other two. The first method, we're going to actually use this graph right here, We're going to use this graph right here for all three methods. The only thing that's going to be different is that we're only going to have one in this video, because if I try and do all three, this video is going to be hugely long, and really you just need to focus on one right now anyway, because the other two actually need calculators or Excel. The first one of the three methods is known as the scatter plot, which basically that method right there, we take a graph and we actually chart out these plots. and we're going to try and find the line of best fit. And this is actually pretty easy with a calculator or anything like that, spreadsheet, stuff like that. I mean, TI-84, I think that's the new one, or Casio, you definitely can do this very easily, very quickly. Your goal is to find line of best fit. That's what we're doing. We're trying to find this linear line. The third method, because I want to skip that real quick. Third method that we're not going, and second one we're not going to mess with is regression. And regression is determined using least square regression. And again, can use in a calculator or spreadsheet programs. And it's a cost equation will be determined and will appear in the same format as the cost equation above. This method uses all data points provided and usually is an accurate version of cost behaviors. It could be more accurate than any other method, but if you're using a calculator or spreadsheet, it will use either the regression or it's going to use the scatter plot, okay, scatter diagram, however they want to say it, okay. The method that we're going to use is probably a little bit easier, very quick, very simple. You don't need a calculator except for actually doing a little bit of math, okay. But you don't have to like program all the stuff. And this is good for like small businesses. If it's a large business, you have the software and more power to you to use that software. So what we're going to use is we're going to look at the high-low method. And it's going to use the highest and lowest production volumes. So first thing we're always going to have to do is look at the graph, and we're always going to look at units produced. Never total cost, because total cost could be completely different. It could have given us two different high-lows. Here we always look at the production, and when we look at the production, you're going to find November has the highest production. We keep that there. June has the lowest. It could be a seasonal, but we don't know that. Anyway, since those have the lowest, we're going to take that and their cost for both of those. Okay? So, the formula that we're going to use is simply this. We're going to find slope. And slope is always the change in cost. So our cost of our high point minus the cost of our low point divided by the change in units, which is units of the high point minus units of the low point. This looks very simple to the slope formula in your regular math class, because it is. That's all we're doing, finding slope. So again, we're going to look at November and June. And November and June, it was 31,000 in November minus 18,500 in June, which gives us 12,500. And that's going to get divided by the high point, 67,500 minus 17,500 to give us 5,000 units. In a misspelled version of units. So, 12,500 divided by 50,000 units does equal out to 0.25 or 25 cents variable cost. Okay, this is our slope. Okay, so our slope will go eventually help us figure out our fixed cost. So how do we do that? Well, we're going to take either the high production or the low production and now times it by our quarter, our variable cost. And for this example, I took the high. If you take the low, you're going to come out to the same part, the same number. So, works either way. And we find out that total variable cost is $16,875. So the next thing we can actually do after we figure this out is use the related total cost for that level to find the fixed cost. In our example, again, total cost for the high production in the month of November was $31K. So we're going to take $31K, and using our formula from above, we know total cost equals fixed cost plus variable cost. Well, fixed cost is my X. We got to figure that out. So all we do is take total cost, subtracted by our variable, and that will give us our total fixed cost. If we looked at this on the graph, our total fixed cost is actually our y-intercept. It will tell us exactly, basically, our constant. Again, that really is our constant. No matter what we do, we at least have to pay $14,125. So once we've done this, you need to put it in our cost equation. So it's going to be total cost is going to equal to our fixed cost of $14,125 plus our variable cost, which is our slope of a quarter, times U. You can put X if you want to, but U for us is units produced. No matter how many units we got, now we know exactly how much it's going to cost us. That's cool. Okay, so this doesn't lead exactly into the break-even yet. We have another thing that we have to do to get to our break-even, and that is figure out contribution margin. Now, contribution margin is basically after we've classified our fixed and variable costs, which we just determined, we need to see how well we can cover our fixed expenses. Basically, can we cover them in case there is a shutdown of production? Because fixed costs is no matter what we do, we still have to pay that. So we figure out this contribution margin. That's going to be our profit pretty much being contributed to fixed assets, or how much money is actually going to get contributed to fixed assets in itself. Not fixed assets, fixed costs. Sorry. So we have contribution margin. It does equal sales revenue minus variable cost. And then we have contribution margin per unit. So you gotta watch out where the problem is stated. Per unit is price per unit minus variable cost per unit. From there, we're able to find out how much is contribute to our fixed cost and eventually profit, if we have any. We can also figure out the ratio. So you got contribution margin ratio. Again, usually it's going to show as a percentage of sales or a percentage of units. Contribution margin ratio is basically our contribution margin from above divided by sales revenue. Same thing with the contribution margin ratio when it's based on per units. It's contribution margin per unit divided by price per unit. Okay? Never variable cost. Always by wherever sales are price. Again, that helps us figure it out very quick. Okay? So, example. Because this one's going to need an example. I'm going to tell you that to go through everything. We're going to use Rydell. And if you're thinking of the movie Grease, way to go. That's cool. But Rydell is actually, I think, an actual football company. I just like Rydell High better. But anyway, they're going to use the following information. They're going to have sales price per unit of $100. Variable cost per unit is $70. So when we start calculating the contributed margin and the contributed margin ratio, basically we have to subtract 2. to get contribute margin per unit. Since it's already in per unit base, we're not going to try and figure out the other one. We're only looking at per unit. So we're not going to get sales revenue or stuff like that. So easy way, 100 minus 70 equals 30. That's our contribute margin per unit. So out of every unit we sell, we have 30 bucks that goes to either fixed costs or profits. And then the ratio in itself is $30 divided by 100, or about 30%. This means if we look at the ratio, every dollar we spend, 30 cents of that goes to either fixed costs or profits. Okay? So there's that. And this finally leads us to our break even. So more formulas coming at you. Okay? So now we know this. We know our contribute margin. We know fixed costs and variable costs. We can now analyze how many sales or volume that we need to do to reach break even, to cover all of our costs, both variable and fixed. Because this is something really big. We want to make sure we can at least cover our costs. So the formula that we got is fixed cost divided by contribute margin per unit. This is to do it in units. Okay, so again, contribute margin is price per unit minus variable cost per unit. And coming back to Rydell, we're going to assume the fixed cost is $24,000 per month, and we're going to see how many units it takes. Well, 24,000 divided by the $30 contribute margin basically equals 800 units have to be produced in order to break even. That will cover all of our costs. Okay, so that basically means if we sell less than 800, we're going to incur a loss. We're not going to be able to cover our costs. But if we sell above 800, we'll make a profit. So that makes a good goal. But if we do just only sell 800, then that basically means we break even. Now, say that we're going to have to do it in a sales dollars. To do this, again, it's fixed costs, just divide by the ratio, the contribute margin ratio. So 24,000 divided by 30%, or 0.3, if you want to put in decimal, means 80,000 of monthly sales is needed to break even in itself. So that includes clearance items, regular sales items, all that. We got to at least hit 80,000 to cover all costs. So if we're selling 800 units at $100 a piece, that does mean we're going to hit 80,000. Okay? The next thing that you're going to see, or something that we're going to pretty much use later also in this chapter, is known as the contribute margin income statement. We can prepare a special income statement that deals with contribute margin, and basically it just breaks it down. So you get sales minus variable costs, again that equals to the contribute margin, minus any fixed cost, and that will equal to our income pre-tax. Okay, reason why we put pre-tax, because we're going to get into taxes later, but it does equal out to income basically before the pre-tax happens. So when we calculate the break even, if we know all this, and basically we just want to make sure it's zero, this helps it out. We take the 800 and times it by each of the costs. Well, 800 times 100 is 80,000. 800 times 70 is 56,000 minus the 2 will be 24,000. So fixed cost would have to be 24,000 to make 0. Okay, and we're going to go use this a little bit later just so you can see how this kind of backs up into itself in case we want to find cost and stuff like that. Here's the nice little graphic of the CVP. This shows exactly where the break-even point happens. And this will happen when our total cost and sales meet. There'll be a certain point. So after that, what lies in between from sales that gets to total cost is profit. Here, on the other end, since cost is outweighing sales, any production that we do right here just means it's a loss. But that's a cool way to see it in graph form. Okay. Ways to impact this. Okay. Break even can be impacted if by some happens we able to decrease in fixed costs. Same thing, break even will increase if there's an increase in fixed costs. It will actually lower if increase in sales price per unit, if variable cost per unit does not change. Also, if a decrease in variable cost per unit, if selling price does not change. So, if either variable cost or selling does not change, but the other one, if selling price increases or variable cost decrease, it can lower our break even. Of course, any kind of contribution combined or anything change in sales price, variable cost, that results in a larger contribution margin. On the other hand, again, it will basically rise with decrease in sales price point if variable cost does not change. It will also rise if there's an increase in variable cost if sales price does not change. And of course, the combination of those two if it results in a smaller contribution margin. So there's our break even. So far so good, right? Well, when we start looking at the analysis, it does involve a lot of different parts of the company. And excess of expected sales over the break-even sales price, this is going to bring in kind of like the margin of safety. Gives us a little bit of a cushion, you can say. And this is the amount the sales can drop before a company incurs a loss. And it's usually percentage. We don't really do too much in dollar, but we keep it more of a percentage base. And they're going, management actually uses a lot to give a good assessment if there needs to be a change in sales, competition, consumers, economics, etc. They're going to be analyzing this just to that of these numbers we give to make better decisions in the company, or worse ones if you got a bad manager. Okay, so the formula for margin of safety, again, if we look at the dollar amounts, it's expected sales minus break-even sales. If we're looking at the percentage, it's expected sales minus break-even divided by expected. So again, we expect these sales, but it's an estimate. We may do real good, we may do real bad. So, Sim Rydell, actually, we found the break-even point is 80 grand. Suspect that they're expecting to have 100K. Well, the margin of safety in its own is 100,000 minus 80,000, which is about 20K. Okay, under margin safety percentage, that's about 20%. Not too bad. So we have 20% of leg room to basically work with before we hit break even and make a loss. So this allows us to actually kind of forecast a little bit of financial performance. And we're going to take a contributing margin income statement to help forecast this, whether it be sales, costs, pre-tax or after-tax income. So first thing we're going to do is we're bringing back Rydell, and we're going to expect them to sell 1,500 units in January. And then we're going to know what level of profit will be achieved if this level of sales is reached. Assume that everything's still the same from before, and we're going to take our income statement. Here, sales 1,500 times $100 each equals 150,000. Variable cost at the same amount of units is 105. Contribute margin now is about 45,000. Well, our fixed cost was 24,000. Subtract those two, and we get an income before tax of 21,000. So that's kind of like our tentative profit right there. Now we got to figure out the taxes. We're going to apply a 25% tax rate to this. So what that means is basically take 25% times 21,000. That's going to give us 5,250, and subtract it from income. So this is our true profit, our true net income using the contributing margin income statement of 15,750. That will be profit if we were able to sell 1,500 units. So this brings us to another formula. Reaching a target income. I know y'all guys gotta love all these formulas that are in Chapter 18. Chapter 18 is very key on this, but they tend to follow the same thing. They just put in something new in usually the top part. So target income in itself is really how much do we want to make in pre-tax. Not after tax, but pre-tax. Can we hit these goals? So target income in units is fixed cost plus target income divided by contribution margin per unit. Target income with sales dollars is just fixed costs plus target income divided by contribution margin ratio. So whatever our ratio is, again, it's going to be more of a per unit basis since we're still on per unit. So now they want to achieve 12K. They go, before taxes are taken, we want to make $12,000. Okay, we're still using the same numbers. So to figure this out, we take the fixed cost plus our target income of 12,000, gives us about 36,000, divided by our contributing margin rate per unit of $30, says that we need to sell 1,200 units to make it to 12K. Okay, so the ratio in itself says basically we may need to make 120,000 of sales revenue. Again, seems about right. So 24 plus $12 divided by our 12,000 divided by our contributing margin ratio of 0.3 will get us to that amount. We can also use this in the income statement. Told you we're going to come back to this. So starting off first, 12,000 plus 24,000 for our fixed cost. This is step one. That would actually help us figure out contributing margin, which is basically 36,000. Step two, if the contributing margin ratio is 30%, which we figured out before, we can divide that contributing margin dollar right here, the 36,000, divided by our ratio, which gives us that 120,000. Thus, that will be right here. That's our sales. And all we have to do is subtract our sales by our contributing margin, and that will give us our total variable cost. This especially works if they want to find the total variable cost or something like that, or something's missing and we forget the formulas. Okay, as long as you can make it through, you'll be fine. Okay, so a little bit more. We're almost done. Okay, trust me. Evaluating strategies. We can use CVP to access changes in operations strategies, such as change in selling prices, variable costs, and fixed costs. The example that again we're going to use is Rydell, and they're going to buy a new machine. So here's us answering those other questions that came up a little bit before, or at the beginning of the chapter. New machine. So the new machine would increase monthly fixed costs from $24,000 to $30,000, and would decrease variable costs by $10 per unit, which was originally $70, so now it's $60. The current break-even sales dollar is $80,000. It will remain the selling price of $100 per unit. Now, when we look at this, and we looked at what increases and decreases are break-even, we know if fixed costs increase, the break point will have to increase. If the variable costs, though, on their own, if they're decreasing, then usually the break point will decrease. However, we're doing both at the same time. So we don't know exactly what's going to happen to the break-even point when both of them are activated, so we must calculate the break-even as it is. When we do this, all we have to do is take our formulas, take the fixed cost, divide by the contributed margin per unit, which fixed cost of course increased to $30,000. Contributed margin is now also kind of increased. It's now $40 because we lower our variable cost. Divide by those two, we find out that now all we have to do is produce 750 units. We lowered it by 50 units that needs to be produced. That's cool. Same thing in sales dollars. If I take 30,000 divided by our contribute margin ratio based on per units, we find out that it's only 75,000. Alright. So let's look at a different way. Example number 2. Instead of buying a new machine, they're going to raise their advertising budget in order to generate more sales. The advertising budget in itself will increase by $3,000, and it hopes to lead additional $25,000 in monthly sales. So we're expecting another $25,000. So how does this impact? Well, first off, break-even will change since fixed costs are changing. It will basically should increase because only fixed cost is increasing. So 27,000 divided by our contribute margin per ratio, which is back to $30, says that we need to produce an extra 100 units to make up this additional fixed cost, which also means we need to make at least 90,000 in sales if we look at sales dollars. Because we believe expected sales to be 125,000 now with the new budget, the margin of safety will also change, and this is where we kind of like it to change also. So again, margin of safety, 125,000 minus 90,000 equals 35K. So we take 35,000 divided by 125, and shows that the percentage now has increased to 28% than 20. Managers have to look at both of these scenarios to see is it going to help? If this actually had a lower margin of safety, probably wouldn't mess with it, but since it increases that means we got more wiggle room in case something bad does happen. even though our break-even point is now higher, we actually kind of still are in good graces. Now, here comes the last part. Answering the question about sales mixes. So far, this whole chapter, we just thought that they sold one product, one football. A sales mix is when there's multiple products being at play or being sold. So, we can adapt the CVP analysis to fit this scenario as well. However, there's a few assumptions we have to have. One, the sales mix of different products is known, and the sales mix remains constant throughout the whole planning period. Okay. So, what is the sales mix? This is actually a ratio of sales volume for various products. So if we look at two products, 10 to 4, means that the company will sell 10 units of a product for every 4 units of another. Okay, this is something that we need to know because we're going to have to calculate something that's also known as composite unit, because break-even analysis needs the variable and the fixed. Well, if we got multiple going on, we have to kind of combine them into one, and thus this is what causes a composite. Okay, so when we're looking at composites, we're going to have to figure this out. So we're going to deal with Rydell one last time. And they sell 3 different footballs now. The basic, ultra, and budget. The sales mix for these products is 4 to 2 to 1. Okay, which sells for different prices, and each of them have different variable costs because they're different products. Of course, fixed costs are assumed to be $192,000 for the company. The following is the sales price and variable cost per unit. Okay, so we got the basic, ultra, and budget: 20, 32, 16, and 13, 18, and 8. So here's where we first create a composite in itself. So we're going to take the composite sales price and variable cost using that 4 to 2 to 1. So for every 4 basic footballs, they end up selling 2 ultra footballs and 1 budget football. So all we do is take those units, or the ratio itself, and times it by the sales price and times it by the variable cost. So sales price for these 3: 4 times 20 is 80, 2 times 32, 64, and 1 times 16 is 16. Means selling price is 160 for all 3 footballs in this instance. This is our composite unit. Variable cost, same thing, and we end up coming to $96. Here we can start creating this break even using this composite. Again, we assume that it's always going to be this way. Again, this is an estimate. So break even right here, we find our contribute margin per unit is 160 minus 96, which is $64. And we just divide that into 192,000 of fixed cost. Means we have to sell at least 3,000 composite units needed to break even. So what does this mean to break actually even? Is that we're going to have to separate these back out. So since it's composite, we want to know how much per unit or per product that we need to sell. So we're going to separate this out. We're going to bring 3,000 and times it by each one based on this ratio. So 4 times 3,000, 12,000 units. 2 times 3,000, 6,000. Of course, 1 times 3,000 is 3,000. Add those all up, and it basically states on a sales mix, we truly need to sell 21,000 total units in order to break even. And it really does tell you how many of each to break even. So basic bear sell 12,000, while ultra sells 6,000, and budget sells 3,000. Again, numbers going to fluctuate in the real world, but here we're just taking that assumption that it won't, and this gives us a good analysis of how many of these units need to be sold so we can at least cover cost. If more of those particular sell, then it may actually help more. Okay, so that's it of chapter 18 in the notes section. So, and if you have any questions, please again put them in the comments below or send me an email. I'll try and answer as quickly as possible. So, this ends another adventure in the accounting world with your host, Professor Naragon.